All right, everybody. Thanks for joining us today. My name is Thomas Castelli. I'm filling in for Brandon Hall. We're joined by Matt Rodak, CEO and founder of Fund That Flip. And he's going to discuss with us today the future of real estate finance and how you can use crowdfunding to fund your flips. So without further ado, I'm going to hand it over to Matt Rodak. And you can always find this recorded webinar via YouTube after it's done. And we'll have a Q&A section at the end.
Great. Thanks, Thomas. And thank you all for joining us this afternoon. As Thomas said, my name is Matt Rodak. I'm the founder and CEO of Fund That Flip. And I look forward to walking you guys through some things to think about around real estate crowdfunding and some of the new technologies that have been made available, recently related to financing projects by using some things online. So agenda for today will be just a quick introduction on who we are and kind of what we do, just to provide some context. A little bit of background on traditional lending channels, how those operate, some things to think about, some pros and cons there. Then introduce you to what is real estate crowdfunding, how it came to be, some of the legislation that was passed over the past couple of years that made all of this possible. And then kind of a look into the future in terms of where I see value creation happening around online lending, as well as where I see potentially this industry going long term. So as Thomas also said, we'll be answering questions at the end. There's a place to ask Q&A here on the top of your screen, at least it's at the top of my screen. Feel free to drop questions in there, and we'll get to as many of them as we can at the end of the presentation. So with that, let's go ahead and jump in. So who is Fund That Flip? We are a marketplace lender for short-term real estate loans. So we're primarily focused on 1 to 4 family short-term debt, people that need capital to fix and flip a home. As the marketplace kind of says in kind of this description, we have really 2 sides of our business. So on one side of our business, we have people that need capital, appreciate fast and affordable funding for their fix and flip projects, so we can fund deals in as few as 7 days. We're super transparent and responsive by leveraging technology. We also lean into data and technology from an underwriting and servicing perspective to make the whole loan closing process happen as smoothly as possible. And then because we are a marketplace business, meaning that we have access to a lot of different forms of capital, we're able to provide the best pricing terms, et cetera, by matching our borrowers up with the best source of capital, whether that's institutional hedge funds, credit funds, family offices, or whether that's high net worth and more private investor types. On the other side of our marketplace, we do have lenders. So folks that are looking for a passive way to invest in real estate and earn an attractive risk-adjusted return. So one of the nice things about our platform is if you are an accredited investor, and we'll talk a little bit more about what that is, you're able to invest in real estate in short-term debt with as little as $5,000 on our platform. Right now, our deals are offering anywhere between 8% and 10% annual returns. A couple of things that our investors really like is that they pay current, so you get an interest-only payment every month. The other thing that's nice is these tend to be short duration loans. So our average payback period is around 8 months, which allows you to kind of recycle that capital, move in and out, and it provides some amount of liquidity, if you will, by investing on our platform. So that's who we are. We've been around really since 2015. We funded now over $135 million worth of projects. We've had no loss of principal on our portfolio. We've paid over $50 million out to our investors, both in terms of return principal as well as interest income. We look at a ton of projects. So we've looked at over $3.3 billion worth of deal flow in the last 3.5 years. Our average loan size is about $230,000, $240,000. Our average rate is around 11%. We're funding deals in 18 states. We have 30 employees. And we've processed over 50,000 payments, so a lot of moving parts. And again, the technology really allows us to do that and to do so efficiently. So that's who we are. That's kind of what we do. The market that we serve is, as I mentioned, is really the single-family real estate space. So we divide that kind of into 2 buckets. The first being short-term flips. About 210,000 homes flipped last year in 2017, which represents about a $46 billion asset class. So a lot of activity happening across the country in fix and flips. It actually represents, as you see here, about 6% of all home sales are actually flips. About 35% of that volume is financed. So not all 46 billion is actually using leverage loans like ours. Some of them are cash. Some of them are kind of joint venture equity partners, et cetera. But it is about a $16 billion market annually for the lending space. The other category that we look at and we do some financing in is around the long-term rentals. So there's actually 16 million single-family rental properties in the country. That's a $3 trillion asset value. The statistic that I like to put out there is 1 out of 8 homes is actually a rental property, which when I learned of that statistic found rather staggering. And I think the other interesting thing here is that this asset class is one of, if not the largest asset class in the world, that being single family rentals. So that's up 70% from 2005 in terms of the number of single family rentals. So we're at historic lows on home ownership percentages. That doesn't mean those homes aren't being occupied. It just means more people are renting single family homes than owning single family homes than any other time in history. The other thing that's super interesting about this asset class is only 2% of these are what we consider institutionally owned. So, the large single family REIT aggregators, if you will, still only own about 2% of this asset class, meaning the rest of it, 98% of it is owned by smaller, more regional mom and pop investors, if you will. And it's really been a source of a lot of wealth creation for a lot of investors across the country. So these are the markets that we primarily serve. In terms of how I'm talking about financing, these are the markets that I'm primarily focused on. But when we get into the crowdfunding piece, you will, I think, be able to connect the dots in terms of how that legislation, can also be applied to other types of real estate asset classes. So before we get into that, that would just be worthwhile to kind of talk a little bit about traditional capital formation prior to the crowdfunding legislation, which we'll get to next. So as most of you are probably somewhat aware of, is there's hard money lenders, or the hard money structure, as I call it. And if you follow the money, right, so it starts from a real estate investor that has a project. Maybe it's a fix and flip. They need capital, so they go to a hard money lender, or maybe a hard money broker. The reality is most of those guys' money is coming from some other type of institutional, call it lender or capital. So a hedge fund or a credit fund or perhaps a bank. The reality of those guys is it's typically not their money either, right? It's some other type of investors, whether that's a pension fund or high net worth individuals or whatever the capital base may be. And the result of this structure, and this is one of the reasons why I started the company, was there's a lot of I call it value seepage throughout this chain, right? So as a borrower all the way on the left end of the spectrum, you
Hey Matt, not sure what happened, but I think we lost audio a little bit. All right, guys, seems like we're having a little bit of technical difficulties. Going to have to see. Oh, here, Matt is back.
I was lost, wasn't I?
Yeah, I think you got cut off right as you were talking about value seepage in the chain.
Okay, great. We didn't lose too much then. Let me fire back up here. All righty, am I back?
Yep, you're back.
Apologize for that. So as I was saying, there's a decent amount of value seepage here, right? From on the origination side of paying, an investor or a borrower that's paying 10 to 14%, and the folks that are actually, have their money at risk, if you will. And a lot of that yield, if you will, gets kind of cut out of the middle by both the lender on the institutional side, as well as the broker or the hard money lender. So we saw some opportunity to kind of shave some of that out of there. The other structure that's common in the space is more of the private money structure, right? So if we start with the same perspective of real estate investor, I need capital for my fix and flip or my rental portfolio. I go to my family, I go to my friends, I go to my extended business network. I'm able to raise some money. And typically that capital can be more friendly, both from a cost perspective and in terms and rate perspective, because you're able to lean into that relationship that you have with the person. The challenge being is uh, there can be, especially if you're operating at scale, more deals than funding available, or that capital may not always be there when you need it. Your network may be on vacation. They may have just bought a boat. Whatever the case may be, like it's not a super reliable way to build capital if you're growing a large and growing real estate business. I'm not saying it's a bad way. And again, there's a lot of benefits to private lenders, but there's also a lot of additional work and some risk in terms of that capital actually being available to you. So that's the private money structure. Third one that's most common, I think, is the bank structure, right? So again, starting from I'm a borrower, I need to borrow money, I'm going to go to a bank. Similarly, banks have investors, depositors. These investors and depositors are protected by a lot of regulators, right? Making sure that capital is not being too much at risk. And the result of that is if you're trying to borrow money from a bank, is banks have their checklists, they have their I's they need to cross, their I's they need to dot, and T's they need to cross. And it can make the process very, very long and very cumbersome from an underwriting perspective. And I'm sure this is not news to anybody on this this webinar that's been through this process. So one of the things that kind of the crowdfunding thing did is it looked at, what are the problems with the industry from a hard money perspective. There's a lot of middlemen, resulting in higher fees for the borrowers and lower returns for lenders. The private money space tends to be very fragmented and can be somewhat unreliable and limited. And then, banks are too regulated and difficult to work with, especially in the fix and flip space. So what happened from an online marketplace perspective is it took a lot of this friction out, right? So it took the people that have the money, the high net worth individuals or the institutions, and it connected them through a technology interface with the borrowers, which allows, you as an investor, if you want to passively invest, to get direct access to deals without the middlemen, pick your own projects, have some of the benefits of underwriting and due diligence and distribution, leverage technology, as well as be able to invest at kind of lower entry points, while at the same time allowing real estate investors, borrowers, to go to one place, right? Come to Fund That Flip or any of the other platforms that are out there, and know that behind the scenes, these companies are working with a variety of different capital sources and are going to be able to place your project into the best capital source so that you can get the best price, the best terms, and ultimately have the best partner to finance your project. So it seems somewhat common sense. And kind of the question gets itself around like, well, why hadn't this thing existed previously? And a big reason for that is around crowdfunding and the legislation that was passed back in 2012. So take you back in time, and if you can remember back in 2012, the economy was not as great as it is today, certainly, and not that great at all. And our friends down in Washington got together and along with some entrepreneurs and said, how can we make it easier for small businesses to raise money so that they can, get the economic machine humming again by hiring people and investing in technology and doing a lot of other things. So Congress in 2012 introduced a bill which was called the Jobs Act, which is short for Jumpstart Our Business Startups, with really the goal of removing some of the hurdles around and regulation around raising money for small businesses. So it was the only bipartisan bill passed in 2012. President Obama signed it into law in, I think, the end of that year. And then, spring of 2013, it was signed into law. the law really what it did was it directed the SEC, the Securities and Exchange Commission, to develop more of a framework around what this meant. So the SEC passed 7 different parts of what became the Jobs Act. The first of which that had any real meaning for real estate was called Title II. And we'll talk a little bit more about what Title II is, but it really was the big thing that opened the doors for a lot of these online investment platforms. So that was passed in the fall of 2013. We opened for business the spring of 14. The other big piece that was passed, I think it's called Title IV, but it's more well known as Regulation A+. It's another exemption that the SEC passed that allows businesses to raise money from both accredited and unaccredited investors up to $50 million. And you're seeing a lot of other companies in the real estate space take advantage of this exemption as well, Regulation A+. So if you want to do some more homework around these, Title II, which is really around what's called Regulation D, specifically Regulation D 506C, and Regulation A+ are 2 of the big exemptions that were passed as part of the crowdfunding that are being utilized by real estate. The third one that was kind of captured all the headlines is really kind of Title III, which set what I consider to be more of the true crowdfunding. And it allowed, again, both accredited and unaccredited investors to invest in things through online platforms that are specifically registered with FINRA and the SEC. And there's some limitations around Title III that present some challenges for most kind of real estate businesses. But there are, I think, some use cases, again, if you want to kind of look at the differences between Title II, 4, and 3. These would be the ones to look at. So I think really the point of this too of this timeline is to show that, from inception of 2012 to spring of 2016, 3.5 years ish, to really roll out this law. And I think there was a lot of learnings as it happened. What I really want to talk about though is Title II, the Regulation D. So before this legislation was passed, if you were going to raise money for your business or your real estate deal, you couldn't, according to the SEC, do what's called generally solicit, right? So you couldn't put a billboard up on the highway saying, "Hey, I'm raising money for this new apartment or this new flip." You could really only raise money from people that you had a pre-existing relationship with. If you did want to generally solicit and take out an ad on the radio or on your website or wherever, there was a ton of paperwork and a lot of hoops you'd have to jump through with the SEC and other state regulatory bodies to do so. That obviously limits your investor pool to people you just know. Investors still generally had to be accredited with some exemptions around how many unaccredited investors you could take into your deal. And the end result of this, right, is raising capital is generally expensive and required a certain level of expertise to do so legally. I'm going to pause here and just give a quick definition of accredited investor, because I realize I didn't do that yet. But accredited investors, again, it's a term defined by the SEC, and there's a lot of different definitions, but kind of the baseline is, to be an accredited investor, you must either have $1 million worth of net worth, not including the value of your primary residence, or be making $200,000 a year if you file taxes as a single person, or $300,000 a year if you file with a partner. There's about 8 million accredited investors, and I want to say somewhere between 70 and 80% of all of the country's wealth is with those folks. But it is, and the reason for it, and I don't necessarily agree with how they define accredited, but the reason for it is the SEC is looking to protect investors around these perceived to be higher risk investments. So that's what we mean when we say accredited investor. So this was kind of the universe before the Jobs Act was passed. Really what happened with Title II is the SEC said, "Hey, we're going to now let you generally solicit investors," right? So if you have a real estate project, if you're raising money for your pizza parlor, or really any other business, the SEC said, "Hey, now you can go do that. You can take out the billboard, you can take out the radio ad, or probably the more common use case is you can open up a website and market that website online to raise money for your business." no real need to file any heavy burden there. I think there's a 1 or 2 pager that you have to file through the Reg D 506C with the SEC, but pretty lightweight from a regs perspective. This obviously opens up the investor pool to all accredited investors. So now if I'm a real estate operator in New York City or Cleveland, Ohio, or anywhere, I can advertise my investment opportunities to folks in California or New Mexico or Texas or anywhere, with certain stipulations. So the main stipulation here is that if you're going to generally solicit, you must be verified as accredited. So previously, all you had to do is ask the person, hey, are you accredited? Great. Sign this form, self-certifying yourself as accredited. What the SEC said is if you're going to now generally solicit, you as the capital raiser must be reasonably certain that the person in fact is accredited. So the way that we handle this is we work with a third party to do either an asset check or an income check to verify that that person in fact is an accredited investor. And that passes, some guidance from the SEC in terms of making sure that we're reasonable certain that we're only taking money in from accredited investors. The big thing here is it provided more of a framework for small businesses around how can I raise money from a larger pool of investors and do so without a lot of regulatory burden, as well as is stay within the rules of what the government determines to be a prudent way to raise capital. So this was the big change that happened again back in 2013. I think one of the interesting things that happened because of that is a lot of venture capital money poured into the space around real estate investing to help companies like ours get off the ground and build technology and build distribution. And there's been a lot of other benefits that have come from that, right? So one of the things that we're seeing is it's helped provide a lot more value around speed for our borrowers. We have access to tons of data, whereas we can make underwriting decisions for our clients within the same day often, and we can get to closings within 7 days, right? So because the venture capital world got excited about this new legislation and the doors that it opened and the market potential that was there, a lot of us were able to invest in things that have provided a lot of other ancillary benefits to serve this community. The other thing is ease of use. So I used to borrow money from hard money lenders. They barely had email addresses, let alone online dashboards and collaborative online closing experiences and ability to pay my interest payment online. All of these other things have also come out of the investment that's been made in the technology to really serve this industry. Similarly, along with that is transparency, right? So very clear underwriting. Our site and a lot of other sites can give you instant feedback on whether or not your project fits our criteria, while still, having some human aspect to doing this business, but at the same time leveraging the best parts of technology to have transparency about what's going on. And the last one is around pricing, right? So by expanding the amount of investors that now have access to this asset class, we've seen pricing compress by 200 to 400 basis points depending on what market we're in. And a big part of this is there's more capital now able to access deals in different parts of the country that maybe didn't have access to New York money or California money or wherever, which is good at the end of the day for the real estate operator, because they're getting access to that capital at better terms and better pricing because of the more efficient market. So these are some of the ancillary benefits that I think have really been kind of, the result of a lot of capital coming into the space to take advantage of this new legislation. I think where it goes in the future, which is super interesting, is companies like ours will build out of our platforms into other services. So if you kind of look at the upper right hand corner, we started off super focused around fast, reliable funding. We've built out deal analysis tools to help our operators make smarter, faster decisions on the projects that they're purchasing. We're working on developing tools around how to discover deals that are on and off market and analyze them quickly. And we'll be building out other services around title insurance and property casualty insurance and, listing your finished projects on the open market and taking them into the institutional buyers and a lot of other things. So I think, and this is when I say we, I'm collectively, I think I'm talking about we as the industry. As our platforms grow and as we think about leveraging the technology that we've built, are ultimately going to be looking and listening to our customers and finding out ways where we can bring additional financial products and services and technology that at the end of the day can help our clients be more successful at investing in their real estate businesses, which in turn help us finance additional projects. So, the real estate crowdfunding or the Jobs Act, I think, was a really great thing for the real estate industry because it brought capital into the market and funded some smart people with some great business plans. And I think years out, we'll look back and see that a lot of this real estate financing market and the businesses and the platform businesses that have been designed really started by this door around opening the ability to raise capital for projects. And I believe that's it. So happy to take questions. Let me pull this up here and see if we have any open. But that's it. That's where we're at. And yeah, if you guys have any questions, feel free to drop them in the Q&A, and happy to answer them.
Yeah, and just so everybody knows, if you guys want to review this webinar, it will be uploaded to our YouTube channel at the Real Estate CPA, and you can find all our future webinars there as well. And Matt, before everybody hops off, in case nobody has any questions or anything, how can our listeners best contact you or get involved with your company?
Yeah, so my email address is here right on the screen, matt@fundthatflip.com. Definitely check out fundthatflip.com as well. And if you have a project you'd like us to look at, pretty easy application process through the website. Or you're more than welcome to email deals@fundthatflip.com as well. And that'll get over to our business development team who can work with you on anything you have there.
Okay, Matt. So we have two questions here. We have one of them is the general one of them says it's from an anonymous attendee, says you mentioned 8 to 10% are the rates for flips. What are the rates do investors earn from long-term holds? Not sure if that's a question that.
Yeah, so we right now our product is focused on the online platform more towards the short-term fix and flips. The economics of the longer term hold product we found isn't all of that interesting for our retail base. So a lot of those loans get placed into other channels. But generally, terms on those longer term loans are, in the kind of 5.5 to 7.5% range on a gross basis. And if we do choose to eventually take that out to our retail base, you're going to probably be, a point or so under whatever that originated rate is for our servicing piece.
Okay. So, all right. Thanks for answering that. We have another question. Is there a general amount? Is there a general limit on the amount that's typically available?
Yeah, so for us, our loan ranges typically are on the fix and flip are typically between $100,000 on the low end and $3 million on the high end. The portfolio loans can be much bigger than that. There's really no upward limit. Typically, we're looking at kind of more of a $1.5 million to $2 million limit on the lower end on the portfolio loans. In terms of how much money can be raised, and I'm going to answer the question more generally. How much money can be raised through these general solicitations? If you're using the Reg D 506C, which is the Title II, there is no limit in terms of how much money you can raise through one of those offerings. If you're going through what's called the Reg A Plus, which is where you can take both accredited and unaccredited investors, there is a $50 million per year limit on how much money can be raised into a Reg A offering. And that does have to go through some SEC vetting and approval, per. Title III is, I guess, the crowdfunding that right now currently I believe has a $1 million limit, which is why you're not seeing a whole lot of real estate deals being done through that exemption, simply because it typically runs out of capacity before you can get to much scale.
All right. And we have another question. What are the qualifications and requirements to get a short-term flip loan?
Yeah, so our business is really designed around folks that are looking to scale up their flipping businesses. So we typically like to see some previous experience, 2 to 3 completed projects on flips. We do lean into experience around if you're a general contractor or a real estate agent, or you have some other relative experience in the space. And then beyond that, we're looking at the deal. How much are you purchasing it for? How much are you putting into it? How much do we think it's going to sell for? What's the profit margin? Assuming you hit all those numbers. We're going to check background and credit to make sure that things generally check out there. But we're primarily basing our underwriting decisions on the merits of the project, and do we believe you as the borrower is capable of executing, the strategy that you've laid out and ultimately getting our loan paid back.
Okay, perfect. And then there's a follow-up question to that one, and is what's the process? What are the steps of the process once the property is under contract?
Yeah, so easiest thing to do is again, go on our website. There's a apply for funding button there. It'll take you less than 5 minutes to drop in the property address, your purchase price, your rehab budget, some other data points around you and your experience. That gets routed right into our sales team, and we're typically reaching out to you same day to get some additional context around the project and your experience. If things check out, we'll move through our underwriting exercise, and again, assuming things check out, typically provide you terms within 24 hours. You like our terms, you sign our term sheet, and we move forward to a close. So relatively straightforward, but the best place to start after you've got something on contract or close to being on contract is drop that application in on the platform.
All righty. And we have another question. What percentage to loan, I guess loan to value, do you do for purchase and rehab?
Yeah, so we'll typically lend 80 to 85% of purchase. We'll do up to 100% of your rehab budget, and our total loan amount is going to get capped out either by that factor, or we'll go up to 65 to 70% of the after renovated value. So we're going to look at, what the lesser of 80%, 85% of purchase plus 100% of rehab, or 65 to 70% of ARV. And that's going to be our max loan amount.
Okay. Thank you. And we have another question. This I think we already covered this, but does more experience mean lower rates?
Yeah, for sure. So we price a lot of different factors into our, or I should say, we consider a lot of different factors that we put into our pricing as well as terms. So greater experience, additional profitability, loan to value, a lot of different of those things that you consider to de-risk the project certainly have an impact on pricing. Yep.
Okay. And we have another one. If we use your services to fund my flip, would I be making a cash offer as far as the seller is concerned?
It's technically still a finance transaction. I think one of the things that we do for borrowers is, and there's a way to apply for this on our site as well. We can provide conditional pre-approval, which a lot of our borrowers find useful when submitting offers. So what happens here is you'll submit that kind of letter of credit or line of credit application. We'll have a conversation with you, learn a little bit more about your previous experience, do a soft pull on credit and background just to make sure that, there's nothing relative to your experience or background that would, prohibit us from moving forward. And then we can issue a pre-approval of $500,000 or $1 million or whatever the number is that makes sense for you, that a lot of our borrowers will include with their offers to say, hey, it's not a cash offer, but these guys can close in 7 days. This is all they do. They understand, they understand the process and can move quickly to close. And we found that our borrowers feel that that's, useful. And I don't know that it's as good as a cash offer, but it at least gives the seller some certainty that, you're not going to have to go to a big bank and wait 90 days to get the financing arranged. But you are working with a lender that knows how to move quickly to help acquire the property.
Thank you. We have another question. Can I use my self-directed IRA to invest?
Yes, you can. And that's actually how I invest in our loans on our platform. There's an additional some additional steps and paperwork that we have to get filled out and work with on the self-directed IRA custodian. But yeah, when you sign up for the platform and you hit invest on your first project, there will be a radial to select that says you want to invest from your SD IRA. Follow those prompts, and yeah, we'll work you through that process.
Okay. And we have about 5 left here. We'll just go through them quickly. Once we get a loan for the project, can we buy our investors out?
Yeah, so all of our when you're getting money from us, it's actually a loan. So we're even though there may be 10, 15, 30 people that invested in your project on the platform, you're really only working with us. Our company is the mortgagor on the project. So it's not per se an equity investment. It is a loan, meaning you're just paying us interest. And if you get another loan and you want to pay our loan off, like we have absolutely no problem with that either. Yep.
Okay. And I think you might have covered this before, but do you have a service built into your platform that verifies whether or not I am a credit investor? If not, are there any plans to add this?
Yeah, so we do the verification of accreditation after the first investment, and it's a relatively easy process. We do use a third party for this, more as a means to kind of have we don't believe it's prudent to be doing this on our own in terms of we have an interest in saying that you are a accredited investor, so we like to get the third party to do it for us. But it's relatively automated. You get an email from us with a link, to a section of their website that's specifically for us, and it moves pretty quickly. And whether or not we iframe that into our site at some point, perhaps, but it's likely we continue to use a third party for the actual verification.
Okay. And we have a question. Do you need a business plan to apply, and are these loans non-recourse?
So the more information you have on the project and the market, and the more knowledge you can give us related to your strategy, the better. From an underwriting perspective, when we don't know something and we have to make assumptions, we're going to assume conservatively. Do you need a 25-page business plan? No. Do we like to see a detailed statement of work that, considers everything that's going to need to go into the project? And can we tie those items out to the photos and the inspections that we do? Yeah, I think we want to see that. So I think whether you're working with us or really any other type of financing structure, we get the warm and fuzzies when we see a well thought out plan and strategy that's put together well. I don't think it's a 10-hour exercise. I think, a little bit of time on making sure that you have an idea of what you're going to do and what you're going to be building to and who's going to purchase the home once it's done, certainly helps your case in terms of getting the best terms and best pricing. These are our loans. Again, I'll speak specific to us. Our loans do typically require personal guarantees, so they are not non-recourse debt. They are recourse debt. On the fix and flip side, really depends on the size of the portfolio and a lot of other things on the portfolio loan side. But yes, our fix and flip loans are typically come with personal guarantees.
Okay. And we have, do you have any plans to go beyond real estate on the crowdfunding platform, like businesses, etc.?
Not currently. I mean, I think I'm a big believer in specialization and doing one or two things and doing them exceptionally well and owning the market. So I think we see a lot of opportunity in the single family real estate investment space, for us to build a platform that can really meet the needs of our customers. I think when any business starts to try to do too many things, you're not able to provide the highest and best service that you could if you were focusing 100% of your time on your core customer and your core competencies. So we're super focused on, really this, again, that 1 to 4 family real estate space and figuring out ways to bring additional value to that type of investor. Like I said earlier, whether that be additional financing products or insurance products or technology that can help them identify and analyze their projects. We think our time is in capital is better spent really providing value to around things that we already know well and where we already have a customer base. So no plans for that in the future, near future.
Okay. And for the final question, someone here wants to pitch this to a few of their friends and wants to know what few bullet points would you recommend so this could hit home in a short way for them?
Yeah, so I think if your friend is looking to borrow capital from us, right? If they're a real estate investor, the 2 or 3 I think are, if I group them together, it's like speed, transparency, and reliability, right? So we're going to move fast. We're going to be super transparent with what's happening, and you can count on us to do what we say we're going to do. I think that's kind of point one. I think the second one is, coming to us as one point of contact, right? You'll have a dedicated account manager that's going to walk you through the process. And on the back end, you're going to get access to a variety of different capital sources. So we have hundreds of high net worth individuals that fund our projects. We have credit funds. We have insurance companies. We have family offices that purchase our notes. So the idea is bring us your product. Let us find the right capital for your project. And the result of that is you're going to get the most competitive pricing and leverage, all with a white glove service, if you will. So, if your friend's a borrower, I would say those two things. If your friend's looking to passively invest as an accredited investor, attractive risk-adjusted returns, right? 8% plus. We pay out monthly, so you're going to get interest payments on a monthly basis. And then the third thing is kind of that duration risk, as well as kind of the minimum investment, right? So your money's only tied up typically 8 to 9 months in our projects, and you can get started with as little as $5,000 to give us a test drive and see if it's something that makes sense for you as part of part of your portfolio strategy or investment strategy.
All right. All right, perfect. So thanks again, everybody, for coming on and joining us today. Again, we had our guest, Matt Rodak, founder of Fund That Flip. Make sure to check out Fund That Flip if you're in the business of flipping homes. And you can always review this webinar on our YouTube channel, the Real Estate CPA. And we will also be sending this out to you via email in the next day or two. And we actually have one last question here we'll take before we wrap it up. As how long can money sit idle?
Yeah, so I'm assuming you're talking about if you invest on the platform, how long is it just sitting there? So the way that we work is we pre-fund all of our loans. That's a good question. So we fund the loans with our own balance sheet before we take them out to our investors on the platform. So the day that you invest, there's a couple days for us to receive your money and clear some of the regulatory burdens, but typically you begin accruing interest within 2 to 3 days of that investment. So it's not like you got to wait for the project to fully fund before we release the money to the borrower. Like that loan's already closed, it's already perfected, it's already earning interest. So that benefits both the investor in the sense that your money's not sitting in a deal that's not funded for 30 days until it funds. And it also provides some certainty for our borrowers that, when we give you a term sheet, your project's getting funded and we'll work out getting our capital back elsewhere. So.
All right. So thanks again, everybody, for attending. Thanks again, Matt, for coming on the show today. Is there anything you want to say before we end?
No, I think that's it. Hopefully you guys found it useful, and look forward to hearing from you. Again, feel free to reach out to me directly or check out the website, and we are here to help. We've got some other resources on our website as well around white papers in terms of how to think about investing, in this type of asset class, and some resources on our blog. We actually had recently posted a couple articles from Thomas and his team about taxes and what have you. So if nothing else, feel free to check our blog out as a resource as well around everything real estate investing.
All right. All right. Thanks. Thank you again, Matt. And we'll talk to you soon.
Thanks all. Have a good one.
Signing off. Bye, guys.